Hey everybody, this is Kevin Gormley, CPA that does financial planning, today to talk about the third quarter of 2017 on behalf of Leading Edge Financial Planning. One caveat, Charlie and I do not believe that short-term performance is important. We believe short-term performance can sometimes get in the way of long-term goals, but we wanted to share some numbers with you, give you 3 or 4 messages that we think are important, and we love feedback. So if you have feedback about what we discuss here or anything at all, we love getting phone calls, texts. You can communicate with us anyway. So U.S. stock market did 4.57% in the third quarter. As a matter of fact, it's a little crazy how much the market has gone up without pullbacks, and I'll get to that in a moment. International stocks, 5.62%, emerging markets 7.89%. Once again, emerging markets doing fantastic this year. Global real estate, U.S. real estate REITs not doing so well. Foreign REITs did very well, not just in the quarter but for the year. And then the bond markets, U.S. bond market up a little less than 1%. Global bonds, ex-U.S. up a little bit less. So that was the quarter. Now here's the first message. The first message is it's really easy to want to chase what is doing well. And so the example that I'd like to share here is just for the year. Foreign stocks for the year have done fantastic, okay? Foreign developed has done 22%. Emerging markets has done 26%. Is it time to pile into these? No. But it's also really good to have a portfolio that has developed in emerging markets. So I'm going to tell you a quick story. About 2 years ago, Charlie and I met with our investment coach from Dimensional Fund Advisors, and we said that a lot of clients were upset about investing in foreign markets. And our person said, look, pick a portfolio of U.S. and foreign. You know, not like that, but I'm interpreting what they said. But you need to stick with it. And getting out of foreign just because it hasn't been doing well lately is a mistake, because the returns will show up when the returns show up. And the last 2 years, this is year to date, but the last 2 years, foreign as well as emerging markets has outperformed U.S. So in the first decade of the 2000s, 2000 to 2009, foreign beat the U.S. market. Since 2010, U.S. has beat the foreign markets. But again, we think a portfolio that's structured with a certain percentage of U.S. and a certain percentage of foreign makes sense, and we're starting to finally see the benefit of owning foreign stocks. So the second part is this small little chart here, the long term from 2000 to Q3 of 2017. So what we see here is we see 2 market corrections after 2000, the dot-com, and then the Great Recession. And now we see that the market is just on a tear. I don't know what the angle is, but it's not 90, it's not 45 degrees, maybe 65-degree angle in the last year or so. So should you put new money into this market, or is it a bubble? The word bubble, by the way, you can't know that there's a bubble until after it pops. So there's no way to predict a bubble in advance, just like there's no way to predict a black swan. A black swan is something that happens that by definition comes out of the blue and you're not expecting it, but then it's obvious after the fact. But one way to think about investing, and so we believe to keep investing. If markets are too high or too low, we don't know. And by the way, if you invested when the market was too high back in 2007, and this is actually from 2008 on, but if you invested when markets were quote unquote too high, you would have gone through this horrible crash down 54%. But equities after 10 years, equities are up 107%, I believe that says, 7.57. So, but some people are like, I don't want to go through that. Well, if you don't want to go through that, then invest in a less aggressive investment style. Put your automatic investments, add a little bonds to the mix. So this is a 50-50 tilted to DFA mix. So if you were to invest in that in 2008, you would have been down 27%, which still sounds really bad. But the difference of getting back to zero from down 27% versus 54%, the difference is about 2.5 years here. That's a major difference just to getting back to even. And again, the 50-50 portfolio absolutely has not done as well during the bull market. But if investing less aggressively, you don't need to be chicken, or there's no shame in buying bonds. If investing in a less aggressive portfolio allows you to continue to invest, then we think that's the message. The message is always be investing. And so we're happy to talk about if you have dollars that you want to put to work and how to put them to work. For many people, it's just keep on investing 80, 90% equities, whatever you're doing. But for some people, if you go lower, at least if the market does go down, you'll have the opportunity to rebalance. So world-class assets, the best market class was emerging markets. Second was small companies internationally. And we do advocate using more small and more value. Now, value did not have a good quarter. Again, long-term value beats growth, we believe, but short periods of time, we have no idea. Speaking of short periods of time, small cap value got all of its return for the year. It got 5.11% in the third quarter. You can see year to date, it's also 5.68%. So as of the second quarter, small cap value was dragging down portfolios, but in Q3 had a decent return. Small cap value had almost all of its return in the final quarter of last year. So again, we think the most important thing is the time in the market as opposed to trying to time the market or timing the market, as the saying goes. So the U.S. makes up 52% of the worldwide capitalization. What that means is 52% of the money that's being invested in markets is invested in U.S. stocks and U.S. equities. 37% of the world is invested, dollars are invested into developed markets. Again, developed markets, small cap, and you would have only gotten small cap if you invested in small cap international. Some people advocate, well, if you invest in the U.S., you're really investing worldwide. Well, you would not have gotten the returns in at least the third quarter with small cap. And small cap international has done almost 24% year to date. Again, I'm being a hypocrite here because I'm talking about just 1 year. But again, the returns show up when they show up. Emerging markets, 11%. Emerging markets growth was the best returner, and emerging markets value was the worst returner in the quarter. But across the board, if you've owned any emerging market classes, you've been very, very happy lately. The best countries, well, who cares? Well, it's still interesting. Norway, number one, Italy, Portugal, Austria. The top emerging market countries, Brazil, Russia, Chile, and Peru. We advocate just owning blocks of the whole market. We don't advocate owning a single country, but it's kind of interesting. Currency was mixed. So U.S. currency, if U.S. currency goes up in value against other currencies, then the returns that you get from foreign markets will be lower. This year, it's not been a big drag on international performance. That's, like I said, international has done extremely well. Real estate investment trust. This is kind of the next message of short-termism and not getting caught up in short-termism. But DFA looks at the market as 59% U.S. and 41% world or ex-U.S. REITs. And so U.S. REITs in the quarter did a little bit better than 0.25%, where the foreign REITs, once again, did many times better. And that's been the case all year, although foreign REITs haven't done as well over the last decade. But here's the message. In 2017, REITs have been bad. U.S. REITs about 1%. Should you continue to invest in these things? Well, the time in the market message here is the yellow, and that's the Vanguard ETF REIT. Over the last 20 years has done 9.12% on an annualized basis versus the S&P 500. So again, although it's had a poor year in 17, you don't invest and you don't look at these things in short-term periods. You hold them for long-term. So I don't mean to beat a dead horse. Commodities, oil, other types of products had a very good quarter. Kansas wheat, lean hogs, corn, live cattle. I don't know that any of us are investing in these, The final slide here before I get to the message, the final message is fixed income. And so fixed income, if you owned a 10-year bond or a 10-year bond fund, you would get a yield of 2.33%. Municipals right now are very interesting. They're up to 2.89%. The Bloomberg Barclays Municipal Bond Index is up 4.66% year to date total of the yield plus the capital gains. AAA bonds is 2.7 yield, and DFA now does have a high yield bond fund, and it's a little bit higher, 3.27. The issue with bonds is that you want to stay shorter term for the most part, and you want to stay higher quality, allow the returns of the stock market to be the returns that really stay ahead of inflation. So the final thing that they have here is quit monkeying around. And you've heard the idea that if you just throw a monkey throws darts at a dartboard, that the monkey will probably outperform the market. Well, when you look at a market cap based, okay, so Exxon here, I can't get my pointer, there it is. Exxon here is a very big company. Apple is a large cap growth, very, very big company. So the reason why this whole monkey business actually works is that smaller companies on average outperform large companies. And if a monkey is throwing it at a dartboard, this is more what the dartboard would look like, or the stock pages, if you will. So there's many more small companies in the universe than there are large companies. Only a certain amount of companies get large. How do companies get large? Well, everybody invests in them. Everybody puts money in them. That's the definition of a large cap company. It's been a lot of money has been invested. So if you're throwing darts at a stock page, you have just as likely a chance, the most likely chance of hitting a small value stock if you're a monkey than large. So, and again, small value has a great return. What we at Leading Edge Financial Planning through the help of DFA do is what we suggest is, as opposed to investing just in the S&P 500, which is the LV, large value, large growth, we say that you build a portfolio that includes more of these small value and small growth companies. So with that, thanks so much for watching. We appreciate all our clients at Leading Edge Financial Planning. If there's anything we can do to help, please contact us. Again, thanks for watching.